Cash is king when markets panic, when liquidity tightens, when assets fall fast. Capital runs to the US dollar, the world's reserve currency, the foundation of global pricing. But what happens when that foundation starts to shift? Over the past 6 months, the dollar index has fallen more than 10%, a significant move for the backbone of the financial system. Not a collapse, but not noise either, because markets reprice trust before headlines catch up. And lately, some institutional investors appear to be adjusting exposure, not in panic, but in recognition that something beneath the surface may be changing. So, the question is no longer just whether the dollar is strong, it's whether the definition of safe is being rewritten in real time. If you hold cash, bonds, or long-duration assets, this shift reaches further than most realize. When the world's measuring stick moves, every portfolio feels it. Hi everyone, you're watching Global Macro and Crypto. Today, we break down what may be driving this change, where capital tends to go when confidence in fiat softens, and why this moment could matter more than it seems. This discussion is not just about a currency. It is about the foundation layer of the modern financial system. Let's start with the backdrop. Washington has once again flirted with fiscal paralysis. Government shutdown risk is no longer a rare tail event. It has become part of the recurring rhythm of American budget politics. Deadlines approach, negotiations stall, debt ceilings get lifted at the last minute. Markets exhale until the next episode. On the surface, a shutdown pauses government activity. Data releases get delayed. Agencies slow down. But one machine never stops. Treasury issuance continues. Interest must be paid. Refinancing never sleeps. You can pause reports. You cannot pause leverage. This is one of the core paradoxes of the modern debt cycle. Now, rewind 1 year. The narrative then was King Dollar. Higher yields pulled global capital into US assets. Financial conditions tightened worldwide. Emerging markets felt the pressure. Commodities struggled under the weight of a strong pricing unit. Owning dollars required no patriotism, only performance chasing. But positioning matters in macro. And when the most crowded trade in the world begins to unwind, the effects rarely stay contained inside FX markets. Here is the key point. The dollar is not facing pressure solely because of external competition. Much of the stress appears internally generated. On several institutional desks, a phrase has begun circulating quietly: "Sell America." Not as a slogan, as a portfolio adjustment. For decades, the United States functioned as the gravitational center of global capital, the deepest equity markets, the most liquid bond market, a legal system investors broadly trusted. Money flowed where it was treated best. But expectations are the oxygen of valuation, and expectations can shift faster than fundamentals. Recently, several traditionally risk-on currencies, including the Swedish krona and the Australian dollar, have strengthened relative to the USD. Under normal stress conditions, investors abandon smaller economies first. When that pattern softens, it tells us something subtle is changing. It does not mean these economies suddenly became flawless. It suggests the premium historically attached to US assets may be getting repriced. For years, macro investors described the dollar as the cleanest dirty shirt in the laundry basket. Not perfect, just less problematic than the alternatives. But what happens when the cleanest shirt starts to tear? Let's reset here, because this is where the conversation deepens. One of the largest pillars supporting dollar credibility has always been Federal Reserve independence. The Fed does more than set rates. It manages expectations, and expectations drive financial conditions. Markets are increasingly sensitive to any perception that political gravity could influence monetary timing, especially as sovereign debt approaches historically elevated territory. Central bank independence does not have to be explicitly broken to be questioned. If investors merely begin pricing the possibility, yields adjust, currency markets react. Remember, modern fiat is not backed by gold. It is backed by confidence in policy discipline. When confidence wobbles, valuation follows. But if we are searching for the dollar's most persistent internal pressure, Many analysts point directly at the federal balance sheet. U.S. sovereign debt has moved beyond $36 trillion, a number so large it becomes abstract. Deficits during deep crises are understandable. Deficits during expansionary phases attract more scrutiny. This is where a frequently misunderstood mechanism enters the conversation. Currency debasement, not conspiracy, arithmetic. When debt compounds faster than economic output, governments historically face a narrow menu of choices. Raise taxes aggressively, cut spending sharply, or allow inflation, over time, to erode the real burden of that debt. Most advanced economies choose some combination. Very few avoid the third path entirely. For long-duration cash holders, debasement behaves like a silent tax. Purchasing power declines without legislation ever being passed. Let's pause again, because a natural question emerges. If confidence in the dollar is being tested, is there a successor waiting? The most common geopolitical answer is the Chinese renminbi. Beijing has been increasingly vocal about expanding the RMB's role in global trade and reserves. The ambition is clear, but ambition and infrastructure are not interchangeable. Start with payment architecture. China's CIPS network handles only a fraction of the volume processed by SWIFT. That gap reflects decades of network effects, and network effects are extremely difficult to compress quickly. Scale creates inertia, and inertia anchors reserve systems. Then there is the bond market. International RMB-denominated debt still represents a small slice of global issuance. For reserve managers, market depth is not a luxury. It is a requirement. You must be able to deploy hundreds of billions without distorting price discovery. But Beijing faces a deeper structural paradox. Reserve currencies typically require open capital accounts, allowing money to enter and exit freely. That openness invites volatility. Meanwhile, export-driven growth models often benefit from currencies that do not appreciate too aggressively. You cannot easily be the world's factory and the world's banker without accepting painful trade-offs. Some macro desks describe the dollar as Hotel California. You can check out anytime you like. Capital controls make the renminbi feel different, more like a lobster trap. Easy to enter, harder to exit under stress. For institutions safeguarding national reserves, exit liquidity is not a detail, it is the rule. So, let's clarify something important. Dollar softness does not automatically mean the renminbi is winning. Sometimes a pillar weakens simply because internal pressures accumulated over time. This may be less about an external currency war, and more about gradual structural fatigue, not visible day to day, but clearer across cycles. Which leads us to the next question. If the dollar faces episodic pressure, and the renminbi is not yet structurally prepared to replace it, where does capital go? History offers a pattern. When trust in fiat is questioned, even modestly, money often searches for assets that governments cannot manufacture at will. Look at central bank behavior. Gold purchases have trended higher across multiple regions, not because gold generates yield, but because it carries no counterparty risk. No central bank can print it during an emergency meeting. At the same time, a newer generation of investors has begun evaluating Bitcoin through a slightly different lens, less purely speculative, more as a potential form of systemic insurance. This framing does not eliminate volatility. Bitcoin remains a high beta asset, but the narrative evolution matters. Instead of asking only where price might go, some institutions are asking a more structural question. What role could it play inside a diversified portfolio? A helpful mental model is to think of gold and Bitcoin as variations of stateless money, assets not directly tied to the fiscal behavior of any single nation. They are not immune to cycles, but neither are they fully dependent on sovereign discipline. When these assets appreciate during periods of aggressive liquidity or rising debt burdens, it is not always a classic bull run. Sometimes the denominator itself is being repriced. The measuring stick is changing. Now, a balanced macro view demands counterarguments. The dollar has been doubted many times before. Yet it remains the core plumbing of global finance. The United States still commands the deepest capital markets on Earth. Treasury securities remain among the most liquid instruments ever created. Legal transparency, while imperfect, continues to attract institutional trust. During acute global stress, capital still tends to run toward treasuries, so a more plausible framework may not be the end of the dollar. Instead, think in terms of gradual privilege erosion, where the USD remains dominant, but the distance between it and alternatives narrows. Let's explore a few conditional paths. What if inflation continues cooling while US growth stays resilient? Real yields could stabilize, reinforcing currency demand. What if geopolitical tensions escalate globally? The appetite for highly liquid reserve assets could pull flows back into dollars. But consider the alternative scenario. If deficits expand while growth decelerates, investors may demand higher term premiums to hold long-duration sovereign debt. That creates a complicated feedback loop between borrowing costs and fiscal sustainability. The big message here is not prediction, it is transition. Structural shifts rarely announce themselves loudly. They emerge through pricing behavior, allocation changes, subtle preference adjustments inside large pools of capital. When structure evolves, assumptions that once felt permanent deserve re-examination, including the perceived safety of cash. Let's zoom out. The US dollar is still the monarch of the monetary order, but perhaps a monarch managing heavier constraints, elevated debt, persistent deficits, and markets increasingly alert to policy discipline. The Renminbi carries ambition, yet remains constrained by the very controls that support domestic stability. Meanwhile, global capital appears to be experimenting with additional anchors, from precious metals to digital stores of value. Three broad scenarios are worth monitoring over the coming years. First, a more multipolar reserve landscape, where the dollar remains first among peers but commands a smaller share of unquestioned dominance. Second, stronger than expected US growth that restores confidence and pulls capital decisively back into American assets. Third, continued fiscal expansion that gradually elevates the strategic importance of hedge assets within institutional portfolios. None of these outcomes are predetermined. Markets are adaptive systems. But for investors, recognizing shifts in trust can be just as important as tracking economic data, because capital ultimately flows where confidence lives, and confidence, once slowly redistributed, can reshape the financial map. In the next video, I'll break down how a potential shift by the Bank of Japan could force a global repositioning, and what that means for investors. Thanks for watching Global Macro and Crypto. I will see you in the next one. If this added clarity to your perspective, hit like and subscribe. Now, let me ask you this. In a world where the dollar faces structural pressure and the yuan remains constrained, what do you believe is the most credible store of value over the next 5 years? Gold, Bitcoin, or real estate? Leave your view in the comments below. This content is for educational purposes only and does not constitute financial or investment advice. Always do your own research.